In today's video, we are going to discuss about Alibaba and whether Alibaba is a stock investment that can be a good addition to our portfolio. So for those who are new here, my name is Vincent and I'm a 39 years old Singaporean. I am passionate regarding about investing and learning about making money in modern times, and in this channel, I share my learning and experiences with you so that I hope all this can be helpful for those who are also on the same journey towards financial independence. So let's dive right back in. So what got me to pay attention to Alibaba? I think first of all is I have this website called Guru Focus, which I signed up for it. And in this website, I am actually able to see all the investors and the stock performance that they have currently. And this caught my attention because this guy, David Tepper, he averaged about 20% a year for the past 10 years. So comparing this to the great Warren Buffett return is great also, but for the past 10 years rate of return, actually David Tepper won him in terms of the overall portfolio performance. So this naturally caught my attention and I decided to CSI and try to understand what are the things that he have been investing in, and maybe there might be some interesting addition that I can add into my investment portfolio. So let's take a look over here. So his top 10 holdings consist of all these counters: Alibaba, Amazon, Pinduoduo, Microsoft, Vistra, JD, Google, Meta, Oracle, FXI. David Tepper's strategy is he's a contrarian investor, meaning he tries to look for times when people are fearful and prices of assets are pretty depressed, and he will go looking for deals. And with the US-China tension currently that is happening, you would have noticed that China counters are not really trading at very premium prices as of now. So you can do see Alibaba, JD, there's one more, Pinduoduo and FXI. Out of the top 10 holdings, right, 4 holdings are actually have China exposure. So today's topic, we are not going to focus on all the counters. That will be impossible and time consuming, but I'm going to focus on this top holding, which is Alibaba. So before we want to understand the company and analyze the company, whether it can be a good investment thesis, we want to understand the company, what it does first. So Alibaba in general is actually a leading B2B e-commerce platform for global trade. We would have heard about Taobao, Lazada. All these are actually part of Alibaba arm. So let's take a look at the business structure. So for the business structure, China commerce itself is the biggest component of how Alibaba makes money. So for Alibaba, the biggest component is the China commerce. So if you take a look over here, the biggest component over here have the marketplace, retailer, and wholesale. So wholesale is more of a B2B. Then marketplace of 3P. 3P stands for third party, meaning it's a bit different like Amazon. Amazon itself, they have their own logistics systems, but Alibaba does business a bit differently in the sense that they actually have the platform, but in terms of like deliveries and logistics and inventory, that would be more towards the own independent parties. So that's the reason of what it caused by a third party. They don't hold inventories. Then basically the retailers itself, they are the ones that hold inventories. But of course they do have 1P. 1P meaning they are the ones that are doing the holding the inventory, doing the logistics itself. So this China commerce is the biggest segment of their revenue. Then, of course, there's the expanding international commerce. That would be something that we are more familiar with in Singapore. Lazada, Taobao. Okay, Taobao is actually over here also. Then local consumer services. These are the things that people use in the services that they use in China. Youku, digital streaming, their R&Ds, and Alibaba Cloud. Okay, so this is actually the whole picture of how they structured their business and how they make money. So how Alibaba make money, right? Majority of the revenue comes from the commerce segment. So you can see this is 46% is on the commerce segment. Cloud itself is still holds a very small component, only 11%. Then logistic itself is also a very small component, about 10%. So from here, we do see that the company itself is making good profits, but cost of goods is slightly on the higher end. It's not like a software company, so cost CapEx expenses definitely would be much higher. So if we look at the Alibaba revenue breakdown, so I did this summary table from Perplexity. China Commerce Retail itself, based on 2024, 46% is from China Commerce Retail. So that will be your Taobao and your Tmall. International component, right, is only at a smart spot, much smaller percentage at 11%. Cloud computing at 11%, logistic for Cainiao is at 11%, and the rest itself, right, will be at a much smaller percentage. But the interesting thing that we want to take a look into is more on the growth of the company. Because whenever we invest, we want to invest towards the future of the company. And we can see that even though China Commerce Retail holds the biggest pie out of the revenue, the growth itself is much slower. So for 2024 year-on-year growth is only at 4 to 5% single digit growth. So I believe Amazon is about 7% or 8% slightly higher. International e-commerce is the one that looks juicy and interesting because as of now, the international e-commerce in for Alibaba is only 11% of their revenue. If they are still able to continue the growth rate of 32 to 60%, this will definitely become a much bigger segment contributing to the bottom line. Cloud computing, 13% growth. This is a high margin business like for Amazon AWS. So if they are able to actually rev up in terms of the growth in this segment, this will definitely contribute hugely to the bottom line. Logistic growth itself is also seems pretty good at 28% growth. Then the rest of the digital media and entertainment is much smaller, not really a big contributor. Okay, so let's take a look at the revenue and cash holding. For the revenue for Alibaba, the good thing is since 2013 itself, right, it has grown exponentially. Then subsequent itself, right, I think after the clampdown in 2021, 2022, they didn't really did very well. There's a drop in terms of revenue, and this is something that we don't really like. In a business that we want to invest in, the ideal case is hopefully revenue keeps on growing year on year. It makes things predictable and easier to guess what is happening to the business. But what we can see is that it's on the upward trend, slight pullback in 2022, recovery in 2023. Okay, but they are profit making. The green lines are actually all in terms of net income, means it's a profit making business. The company don't really hold too much debt in terms relative to cash. So it's also not an issue that we won't really worry that Alibaba will run into liquidity issues. Okay, and we want to understand a business. First of all, profitability is very important because basically it means we are investing into companies that are providing solid cash flow. So Alibaba is profitable. Then for the past 10 years itself, it has been profitable for the past 10 years, which is great. But operating margin itself, right, is on a lower side at 13%. Okay. Then return of equity itself, basically it measures how much an investor invested into the company and how much return is this company able to generate from the shareholder capital. And that will be 12%. ROIC is something that I look at also because this component for ROIC, the difference between ROIC and ROE is ROIC takes into accordance of debt also. So some companies can have very high ROE, but it might be because they never include debt into the calculation. For ROIC itself, right, it's only at 8.31%. Generally, for me, I would prefer to have companies with ROIC higher than 10. 10% would be ideal. So 8% plus, not ideal, but close to it. But to give a bit more relative in terms of all these things, right, all the factors, we want to compare to companies so that at least we can do a comparison. So let's compare it to Amazon. Okay. So as you can see, in terms of gross margin, both has a high gross margin, but back to operating margin itself, they don't really have very high operating margin. ROE for Amazon much higher at 24 compared to Alibaba, and ROIC itself, right, for Amazon itself is also at 14%. It's also much higher compared to Alibaba. So this is something that we need to take note of. So looking at valuation, for Alibaba valuation, price to earning ratio is considered, I think, pretty fair because price to earning at 17 times, it basically means that you're paying $17 for every $1 of their earning. And forward P ratio takes into accordance of the growth for next year earnings. And that itself will bring you down to just 11. So taking this to make sense of these numbers, we need a comparison. Amazon itself, price to earning ratio is at 34, forward PE is actually at 30. So based on this itself, we can see that Alibaba definitely is priced is more fairly priced in this manner compared to Amazon currently. So growth rate for analyst prediction itself, right, for the future 3 to 5 years earnings, it will be growing at 10% for Alibaba. For Amazon itself, right, future earnings growth for analysts, they are predicting at a 17% growth. Growth rank itself, I think Amazon holds a better picture over here because people are more bullish towards Amazon compared to China for Alibaba currently. Okay, but I do see some interesting things over here. For shares itself, right, for the past few years since 2022, Alibaba management has been buying back their shares. So when a company is buying back their shares, it means one thing. Basically, they think that the shares is undervalued. So if they think the shares is undervalued, they are actually using the whatever cash holding that they have, they start buying back in terms of the shares outstanding in the market. So when the supply of shares drop, basically what happened is that the price will increase in a manner. So this will actually help to boost shareholders' value. So this is a very positive sign. Okay, so I think I want to look at some opportunities over here. So the opportunities I can see is that if I compare it to Amazon based on PE ratio, it is definitely trading at a fairer PE compared to the American counterpart. And there is actually high growth opportunity in the international e-commerce because 30 to 60% growth year on year. So if they still follow the 30% growth trajectory in the next 5 to 6 years, right, this will start to add this will actually catch up to their China commerce segment. And there are also some good news regarding about the political stance in China because as we know in 2021 there's the clampdown on tech industry. So Alibaba during that period of time, I think the stock prices came crashing down from like $300+ to like below $100 itself. So right now the change of political stance is fantastic because in the news what we are looking over here is that during the meeting with Xi Jinping, with all the other entrepreneurs and CEOs from Tencent, I think Ma Yun was there also. They actually interviewed and subsequent itself, right, China is placing emphasis on the development of tech enterprises in the bid to break through the US tech blockade. So the US tariff situation, I think, also brought attention to the Chinese government, and they themselves, they understand that they can't really clamp down on their tech growth because it will be destructive for their own economy. So with this change of stance, I think it's a good sign because the only concerns that we have when we invest in China companies are we are aware of political risk because any change in stance politically, it can affect the market. And the next opportunity I can identify is that they are the biggest cloud player right now in China. So they actually hold 39% of the cloud market in China, and this is a good thing because as we all know that right now the AI growth and cloud computing growth and cloud computing business is something that has the highest margin. So for Amazon, it's the same thing. Margin for their e-commerce is not as high compared to their AWS, which is their cloud computing arm. So if they are able to continue to dominate for Alibaba in the cloud market and to have growth in this segment, I think that this will be something that will be very attractive for their bottom line itself. So as you can see, Alibaba has 39% of the market share, Huawei has 19%, and then Tencent Cloud has 15%. And the next part is they themselves are also investing towards AI and cloud computing. So they plan to spend 53 billion spread across 3 years, aiming towards AI-related product revenue. And this is a fantastic news. Of course, there are pros to cons to this. The good thing is they are still focusing on these which are going to be high margin revenues, but it will take time to reach a significant contribution to their bottom line. So Alibaba executives see explosive growth in the AI applications in China in 2025. So I believe they themselves are also riding on the AI story and they are planning to invest heavily on this segment. Okay, so enough of the opportunities. We have to understand what are the weaknesses that we are looking at right now. Whenever you're investing in China companies, there is always China risk. Political risk is there. because one change of stance from the political party, and you can see very big volatility in the companies that you are investing in, which is what we saw in 2021 when they came out on the education and the tech segment. And I do see weakening operating margin, which is also a concern. And subsequently itself, right, this operating margin might further drop if they actually continue to spend heavily towards the capex for their AI and cloud. So you can see over here in 2015, operating margin, meaning in terms of like from their businesses, how much they are actually able to get a profit from there, is actually 30%. Then subsequent 2016, 17, 18, 19, 20, 21, 22, 23, 24, you do see that that is eroding operating margin, which is something that we do is not ideal, because if let's say a company itself keeps on decreasing their margin, basically they are in a price war. So price war is something that we want to avoid. We want to get into businesses that have very great pricing power, so that even in times like recession, they still can maintain their pricing power. So for example, Netflix recently increased the monthly premium for me up by 15%. But even though they have increased this premium since I have been a subscriber in since 2015 until now, what happened itself is I will not cancel Netflix. And this pricing power will also show up in their operating margin. But apparently right now for Alibaba, this is not something that they have, because operating margin has, what we can see over here, it has been trending down. Only the slight bounce in 2024. And I think the weak operating margin can also comes from the fierce domestic and international competition, because Pinduoduo, JD, Baidu, ByteDance, Tencent, they are the big players coming into the e-commerce segment and also the cloud segment. And international cloud players like AWS, Azure, and Google Cloud, I think they still hold the biggest market share globally. So for Alibaba to go into the international cloud scene, I think that would be also challenging. So AI revenue itself, right, even though right now everything seems exciting, but you do have to understand that even for the American counterparts, the big techs, as of now, they are not able to justify their investment into the AI and turn it into justifiable revenue. Because investing into AI, all this, it sounds sexy, but there will reach a point of time when investors starts asking, where is the money? Okay, you have invested so much into the capex. Okay, and how does it show in the bottom line in terms of the revenue and profit? And of course, lastly, China's economy uncertainty. There are also news of like slowing down in the China's economy, and with regards to the tariff situation, it also adds on another layer of uncertainty itself. So these are the current weaknesses that I think there are for Alibaba. So let's look at valuation. So from Simply Wall Street over here, for valuation, they value Alibaba at 113, and in today's price of 120 is slightly overvalued. And if we look at Guru Focus actually value Alibaba at 101. So right now at 120 is modestly overvalued by Guru Focus. And if we look at Alpha Spread actually valued Alibaba at 125. So at 120 is only slightly undervalued at 4%, and this is actually based on a base case. These are not 100% accurate, but at least it gives you a sense of what is the current valuation but all these different websites are showing you, so that you can come to a decision on your own. Don't just rely on this blindly. I think in today's market, if you want to invest in Alibaba, there are a few things that you need to take into consideration. I think the first thing is the tariff issue. Do you think that this tariff issue is going to be a big problem for Alibaba? If let's say commerce itself, a majority is in within China, I think that wouldn't be too much of an issue. But if they are exporting to US in particular, this will definitely be an issue. But Alibaba financial report, they don't really break down in terms of where they generate their revenue from. So it's very hard to be certain like how much in terms of revenue from Alibaba is actually generating from US. But I believe that it might be a small component. So I think this tariff issue, it shouldn't be a huge problem over here. Okay, the next thing is, do you believe in the cloud and the AI investment will start to bear fruit soon? Likelihood, I think in the next 3 to 5 years time, it will not be something that will be um, a sudden burst of revenue coming from this segment. It's going to be growth over here, which I think will be something that will generate a higher profit for Alibaba. But likelihood, I think this is going to take some time. And of course, do you believe in the expanding international market of China? Because the expanding e-commerce segment in like Lazada, Taobao, or even in the South American market, I think this is something that is the portion that might be the juicy component for Alibaba. And lastly, when you invest in Alibaba, you need to be okay with the China risk, which is the political risk. So as of now, I think what I do see right now for Alibaba is it a viable play? I think yes, it is. But is it right now at this current valuation? Ideally, I think it will be best if we are able to purchase this stock around a slightly better discount with a higher margin of safety around $100 odd. That would be ideal. And if I were to start a position in Alibaba, I think likelihood I wouldn't go full position yet. Maybe a starter position just to get started with, dip my foot into the water and analyze along the way. Because sometimes it's like this, is you have to start investing and then you start to pay a bit more attention because money is at stake. So for me, Alibaba, I think it will be a stock that I will be looking at. It's going to be on my watch list. Is it at the ideal price? No. Maybe a starter position and analyze along the way. How about you? What do you think are some of the opportunities and challenges for Alibaba going ahead? And is this something that you already have in your portfolio? I look forward to hearing from you in the comment section below. And in the next video, I will analyze another company to see whether that might be a better option compared to Alibaba. So if you like videos like this and want more videos like this to be recommended to you, do hit on the like and subscribe button so that videos like this can be recommended to you. I'll see you in the next video.